Government's telling us inflation right now, 8.2% year over year, if you're including food and energy. Where do you think it is today?
I think it really depends on what you're buying.
I'm Drew Brenneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. Great. Well, yeah, this episode, I really wanted to do another deep dive in inflation, and I wanted to try to get somebody who's not necessarily in real estate on the show or works for the government, like just get someone who's really more on the front lines, day-to-day, purchasing things, buying things, seeing what prices are like. Because, I mean, if you're in real estate, like I think inflation is really plateaued, and we're having price cuts. Obviously, if you are trying to sell your house or rent an apartment, like prices are dropping today. So like if you're in real estate and are just only seeing that, you have one view of inflation, which is that it's basically it's slowing or has stopped. But really wanted to get someone on the episode who's in a different seat and could definitely have a different opinion on it. So on this episode, you're going to learn about what's happening today with inflation from someone at Costco, and then what to expect in the future with inflation. And then something that's important to me when I heard how much stuff Andrew buys a year is we're going to get some expert negotiating tips at the end from someone who buys $2 billion of stuff per year. Welcome.
Thanks. Me too.
Perfect. Well, yeah, why don't we just jump right into it? So you're a buyer for Costco. What exactly does a buyer do?
So I'm an assistant buyer in the regional office here in the Midwest, out in the Chicago area. So we handle the 13 states in the Midwest, everywhere from North Dakota down to Kentucky. So our buyers manage all the categories within their department. They're responsible for the item assortment, sourcing from different suppliers, ordering and distributing them to each of our locations that they cover. They handle the pricing negotiations, so they're right on the front lines, really seeing what's driving the dynamics behind every single cost increase that you see for each of the items. So we work on the pricing and profitability and help manage any issues that arise with the items. And we're the only place in town besides other wholesale clubs where you have to pay a membership fee to actually walk in the door for the privilege to shop. So our job, we take very seriously in terms of giving that value back to the member by working hard to fight these cost increases whenever they aren't justified. And making sure that they have everything in stock all 7 days of the week, because that's the most valuable thing that we're selling at the end of the day, is that membership fee.
What kind of products are you buying for Costco then?
So I started out buying the candy department, which is everything from salty snacks to nuts to protein bars. During the whole COVID pandemic, I was buying frozen food, which was one of the biggest impacted because there's so many people working at home, looking for something with convenience. And now I buy the Sundries department, which is everything from toilet paper to pet supplies, Ziploc bags, all of the consumer packaged goods that aren't necessarily food.
Okay, nice. Yeah, so that's like a broad spectrum of different things you're looking at. So then government's telling us inflation right now, 8.2% year over year, if you're including food and energy. Where do you think it is today?
I think it really depends on what you're buying. Those numbers are their best guess at aggregating, a typical basket of goods for a consumer or for a household, and they haven't done a whole lot to tweak that to shopping patterns. And I think definitely in the past couple of years, you've seen quite a bit of change to what people are buying, where they're buying it, and how much they're spending on those things. So in my opinion, I think some people are experiencing inflation close to the double digits, but if you account for the changes to those shopping patterns, people aren't spending on gas because they're not going to the office. They're not spending on other transportation or travel. So there's quite a few households that probably aren't actually receiving that much inflation at all.
Interesting, because they're cutting back on those things that have spiked, whether just intentionally or just sort of worked out that way with like gas and not needing.
Yeah, and some of it is that they might be allocating it because of the prices going up, but I think much more of the drivers for the people who aren't actually experiencing that much inflation is because there's just nothing to buy in those categories. There was no travel for years. Office space was shut down, so.
Right. Yeah, makes sense. Yeah, even for me personally, like I've wanted to buy a new car for like a couple years, or not. I don't buy new cars. I buy a new car to me that's used, but I just haven't. I mean, prices have been so high in used cars. The car I have now is fine, so I just haven't.
Yeah, and we had a time where used car prices were higher than what new cars were. The gap kind of shifted.
Yeah.
And I bought a new car this past year, and I had to wait until it came literally off the truck from the factory, and I got it the next day because they were no cars in the lot for the ones that I was looking for. So I think that now we're getting back to a spot where there is a little bit more supply out there. We're not having to chase down every last truck of stuff. We can be a little more discerning in what we're buying, and that allows us a little more flexibility to negotiate on those sort of costs.
Yeah, it makes sense. And I know a lot of retailers, because this was, I didn't know if this happened to Costco, but it was in the news a lot, having happened to Target, where they got stuck with a ton of inventory, where they just bought everything they could, then they couldn't sell it all. Now they're discounting it. Like when was that happening?
I think that's kind of been a slow, gradual shift back to normality, I guess you could say. And it depends on the category and on the department. Some industries were able to shift to meet the new consumer demands pretty quickly. But like if you look at toilet paper, for instance, people weren't, going to the bathroom more frequently. They just weren't doing it in the office. And, the single ply toilet paper that everyone dreads in the office or in public spaces is not the same toilet paper you're going to pick up when you're shopping for your own house. And the manufacturing facilities for those, they can't just switch from one to another. Whereas, some food items, they can change those pretty quickly because, they're used to constantly changing the ingredient decks, new flavors, that sort of thing. So I think that you will actually start to see across the board on those sort of bigger items a little bit more discounting, and not just because there's way too much of it out there, but because we're finally back to being able to be at a normal inventory level to run promotions that we have been holding off for 2 years now. So I think that will probably bring overall costs down, just because you're going to see a lot more availability of goods where you can start promoting them. And I think that's, it's all a factor of supply and demand. And we had a time when there was a lot more demand at the same time when you had a lot of supply constraints. So it was probably about 50-50 on each side of that, with production facilities not being able to run at full capacity and the demand not matching what demand was for each of those things a year prior.
Yeah, makes sense. Well, then what do you think? Are you seeing, so that could be a reason inflation would be slowing in the future, but are you seeing inflation slowing or dropping, or what are you seeing day to day right now?
I think one big light at the end of the tunnel is that availability of items, where we're not as supply constrained and had to hold off all of that promotional activity. You're seeing a lot of commodities start to come down, which in time will lead to that trickling down to what consumers are paying. You see the energy composite starting to finally take a little bit of a reprieve. Agriculture and metals have been coming down for a few months. This time last year, I think, was the peak of shipping container costs. It was $10,000 plus for a ship coming from Asia. Now that's down to roughly $4,000, and those costs are largely impacted by all of the freight that is not coming here, because there was such a huge jolt of inventory coming with all the backups at the ports.
Yeah.
But I think that the prices will come down because there is so much inventory available, and because those commodity costs for new manufactured goods are gonna keep those costs a little lower than what we've seen.
Right. So a lot of the inputs, those prices have dropped. Then they can offer the goods for less, and there's not as much demand on it now. So now there's not as much pricing power.
Yeah.
You're saying, okay. Inflation then, just to hear, right, like actual inflation was probably more than the 8% that's being reported, but people have adjusted their spending where they're not actually experiencing the 8 then?
I would say that, for the people that are, experiencing that full 8.2% inflation, most of those households have seen the same wage increase. So they have not been cutting back on spending as much as I think the Fed might be trying to achieve. And from what it sounds like from them, they're not comfortable lowering the rate of their increases until they start to see that consumer demand start to falter a little bit. And we're still in the highest inflationary time in my lifetime, and at the same time, we're in the best labor market that we've had in decades. And wage growth is continuing to help support people's spending habits to meet that 8.2% inflation. So unless until people can't really afford the inflation that they're seeing, they're not gonna tighten their belts and start cutting back.
Yeah. What about then for Costco? Did you guys see? I saw a chart that you gave us where it was like in June sales had dropped off of this year.
We release monthly sales data, so there's not ever a whole lot of surprise when we do have our earnings because we're giving monthly guidance, and you're not seeing a huge decrease in how much people are spending, but you're definitely seeing a little bit of a slowdown to the growth that we experienced in the last 2 to 3 years, and that's consistent with the rest of the market. But overall, consumer spending in September, didn't take the dive that the Fed I think is looking for.
Yeah. Okay. Interesting. Yeah, because this chart that I was looking at, it had the I guess it wasn't percentages, it was like the volume. So I had thought, it
sales per warehouse per week.
Yeah, I thought it did take a dip, then not just as like the growth, but then the way you looked at that, that's more. What did you think when you saw that drop in the sales per warehouse per week in June?
Well, I mean, year over year, it's still way above what a normal year of growth would be. I think that in terms of how much people are willing to spend. The total volume is still there. You're seeing people, maybe tighten their belt in other ways, going to, cheaper proteins, picking the select steak instead of the prime steak, moving from those sort of proteins, the steak or, the expensive meat alternatives to cheaper proteins like eggs, chicken, milk, that sort of thing.
Got it. Okay, nice. Yeah, because it was definitely up a lot over 2021. I didn't know if your take was, okay, actually what the Fed's doing is working. We're going to create this, ruin the demand and create to stop inflation. And look, it worked. Like now we were on a certain trajectory and then dropped.
I mean, I think that's their goal ultimately, right? Is to put a little more pressure on spending overall by making money more expensive. But when wage growth continues to be as high as inflation has been, people are still willing to spend because they don't feel that inflationary pressure.
Interesting. So then what do you guys think is going to happen with wage growth like in the next 12 months, would you say?
I think that people's expectations of where inflation is going to go typically is what you see in wage increases. I don't think that we're going to see a wage spiral that they talk about where, employers are constantly trying to match what inflation expectations are. I think that, in the next couple months, if the Fed does start to see some of the data work in their direction where they're, seeing what they want to see, it's a little more comfortable for them. They're going to be able to start at least indicating that they're willing to lower the rate of their rate increases. I think that'll be a pretty strong message that there's the light at the end of the tunnel, and we're not going to have a huge wage spiral and persisting inflation at the 8% rate. I don't think that it's going away anytime soon, but I think that until the Fed starts to see the data that they want, they're going to continue to increasing interest rates until consumer demand data starts to show that what they're doing is having some impact.
Interesting, because they're having a big impact, these rate increases on the real estate industry, where I mean every place that does lending, whether it's on commercial properties or single family homes, I mean it's like huge layoffs at those companies. And one of the biggest commercial real estate like service provider companies, is called CBRE, where they have real estate brokers and lenders and advisors there. They just announced they're going to try to cut $400 million a year of spending, mostly through layoffs of people that work there. And like, so it's interesting to hear your answer, because like, at least from my seat, it's like, yeah, this is having a huge impact. Like the deals you were going to buy, you can't pay as much for. So then that slows the whole industry down. So if you're providing one of those services, there's way less work. People start getting laid off. Prices start dropping. So like the Fed's had a huge impact on the real estate industry, but that's just one, piece of the whole pie.
That's the first domino to fall is the price impacts are immediately on mortgage rates, which affects housing price. You immediately saw a strengthened dollar, but until that starts to trickle down, so to speak, the Fed rates are really a gravitational force. It starts to affect what is closest to the center, right? Things that are impacted by those rates directly. But to curb consumer spending, which is much of the pricing that inflation's coming from, is going to take a lot longer to have that same impact.
Interesting. Then when would you think we're going to start seeing the inflation numbers drop?
That's a tough question, because it's, as much as you polish your crystal ball, it's always going to look cloudy. Even the Fed, their anticipated inflation numbers coming out of December of 2020 was less than 2%. That didn't happen. The following year, in December 2021, they said next year's inflation is going to be 2.6%. It's 8%, right? So it's really hard to say what it's going to be, but what I can tell you is that they've been very clear that they're data-driven, and they're looking at the inflation numbers, and the inflation numbers are much less reliant on the housing costs and the things that are immediately impacted by these rate changes. And I think that it is probably going to take another 4 to 6 months until they start to see the data that they want, where they're going to be comfortable pulling back.
From my real estate vantage point, like if you're doing year over year numbers, we have lower numbers now. So it's definitely less than 12 months away having the inflation number roll over. And then also what I would say is the inflation month, when you look at it year over year by month, they get into some really high increased numbers once you get to December 2021. So now they're running into high comps, if you will. Mm-hmm. And like at least real estate's, with no surprise, like home prices are dropping and rents are, depending on where you are, flat or have dropped. So like some stuff's rolled over and we're running into high comps, but you're seeing price cuts? No, still.
I think there are prices coming down because of the kind of trickle down from the commodity prices. And the fact that I think people are starting to, buy a little less volume of certain goods. I don't see inflation sticking at 8% for much longer. Definitely not for the next 3 months. How long it's going to take to drop back below the 6% that it kind of hovered at 8 months ago, it's really going to depend on how far the Fed's willing to go in keeping their rate rises going.
Okay.
And they've been pretty clear that they would err on the side of overdoing it than underdoing it, and keeping inflation around for longer than they'd like. They want to put a quick end to it.
Yeah.
And I think that they're going to continue to act aggressively until they start to see those interest rates go down. And when they do go down, unless they do start to kind of taper their increases, it will drop, I think, pretty quickly.
Yeah. The way they do their surveys and get their data, it's not too late, or they're doing raises 6 months more than they needed to, because that's what they've traditionally done, the Fed, and then they need to cut really fast. Like in the last two 2 or 3 rate hike cycles, so 2018 and I don't have them memorized, but then sometime around 2006, and they, like the last 3, they had to cut again in 8 months or less because like they overshot it. Mm-hmm. So I mean, that's where I think a lot of this, like next year we're going to see the employment market soften a lot. I mean, just any real estate company is already making cuts, so like that's like a, especially from what I look at, I'm like, there's not, like, things are actually starting to slow now. And then that's definitely trickled over to tech, because they're heavy on growth. And if we're going to be in a flat, let's say, economy, then it's like, why pay such a crazy multiple or invest in this tech company that makes no money yet? And then they all, then that just there's less engineers to hire, and, it keeps trickling through. And the longer they let this keep going, the worse it's going to be. So.
And I think those job numbers are something that they keep a very close eye on, right? Because they have a dual mandate: keep inflation at their target and then maximize employment. We're in a really strong position on employment, but if those sort of things start to happen in other industries, they're going to have to kind of double check what they're doing.
Yeah, but then to be clear, so I'm seeing rents drop, home prices drop, and like real estate companies lay people off. Mm-hmm. From your standpoint, what are you seeing with the prices of the things you're buying? And then you said you thought employment was we're in a really strong labor market, right?
Yeah, we're in the strongest labor market in terms of unemployment and wage growth that we've seen in at least my lifetime. And I think that gives them a little wiggle room on how far they can go, and before they have to do a correction on them overdoing it. I'm seeing a little bit of reprieve on a lot of items on the food side. I'm mostly just focused on what I do day to day, but on the commodity side and the inputs side, and definitely on the meat and energy, you're seeing beef come way down from where it was last year. Chicken's on the way down. These are the things that consumers are seeing day to day, and is going to impact their ability to spend on other goods.
Yeah, I mean, that sounds like it's more of a mixed bag, though. Some things are dropping, some are increasing.
I think that the rate of cost increases is definitely slowed, because you are starting to see so many items have cost decreases for the first time in 2 to 3 years, and with the commodity and energy costs going down a bit, that gives a little more wiggle room to negotiate costs, especially now that we have some supply out there. So they're going to have to, companies are going to have to start lowering their costs just to get through all of the goods that they have.
I think that's great, and that's plenty on inflation. So then let's see. I was going to ask you too, like, what's the deal with this $1.50 hot dog?
Well, that's right back to inflation, right? So I think that's kind of our mascot on how we handle cost increases and inflation. It's been $1.50 since I think 1984, 82, something like that. And we are able to achieve that in part because we decided, we're dedicated on that, and we're going to have to figure out a way to do it no matter what. So those hot dogs are now, made internally by one of our, meat packing facilities. But, there's a lot of articles out there, about this $1.50 hot dog, saying that our founder, when he handed over the reins to the current CEO, Craig, says, I'll effing kill you if you change the price on the hot dog combo.
Yeah.
And that's the thing that, they asked the CFO, and his answer is a swift, no, we're never going to change the price on it.
Yeah.
And I think that that speaks to the way that we handle our negotiations and our view on inflation, is that, if we're able to, it will be the same price forever.
Yeah. Yeah, and just even one thing that was memorable, kind of just chatting with you, like right before we got started, was interesting, where when I was asking about like what's going on with prices today, and it was like, I've got so many price increases still to deal with. It's like I can almost not keep to like work on them all.
Yeah, I mean, but before the COVID pandemic started to have such a huge impact, we would get cost increases. A couple would come across your desk a month. There were times when you would get 2 a day for 2 weeks straight.
Yeah.
And it can get overwhelming, and that's you can see that in the inflation numbers. But that $1.50 hot dog is, that's our beacon.
Yeah. But then on all those, and then it's your job, or you have a team for this? I assume not. It's your job then to try to get the price back down. We have an increase, try to get it back to where it was.
So we have, whenever I get a cost increase, we ask a lot of questions. What's driving this? Make sure that it's justified, because the answer we don't want to get is, well, we just think the market can bear these higher prices. So we know that a lot of these cost increases are coming from direct inputs going up, but now that we're seeing those commodity prices come down, we can go back to the suppliers and say, you passed on this 30 cents because shipping was up 30 cents. It's now down. Let's get that 30 cents back.
Yeah. Well, that's a good negotiating tip then for anybody.
Yeah. So, and we know that those 30 cents that we can save members, they're going to come back and shop, and those 30 cents are going to go straight back into a hot dog combo.
Yeah. Nice. Yeah, no, that's a good tip. You got any other tips on negotiating, or?
Get yourself in a position where you can have the power to say no to something.
Okay, nice. That's a good one. Yeah, usually whoever wants to do it more ends up getting the worst deal. Yeah. So a lot of the best deals I bought.
And that's the great part about, having an operating model where you're limited SKUs. I don't have to have a full assortment in a category. I can just pick the best seller. And, if we don't have a value to the market, we're in a position where we can say no.
Yeah, it makes sense. Or they're not necessarily looking for this exact item. Like, it's more like there's like a, it can be any type of X. It's not just needs to be this exact brand.
I mean, there's been times where we've stepped away from pretty major brands like Coca-Cola for a time because they weren't getting to a price point or a value that we were comfortable with. And if you have the power to say no, you can say no.
Yeah, that's a good tip. Because I was going to say a lot of the buildings I bought where I feel like it's the best deal. It's like the ones it's like 50-50 on it's like, if I can get it at this price, I'll buy it. Otherwise, I don't really care. And then I offer like, a pretty aggressive price because I'm not that pumped about the deal. Then you get it and you look back 5 years like, wow, that was my best deal of that time. Yeah. It was like the one you didn't almost care about.
And that's the one thing that, is the most important for the buyers in our position is to ask questions, because we need to be experts in whatever we're buying so that, when suppliers do have issues that come up, we can help them, and work together on achieving, something that works for both of us. Because, for us to prosper, our suppliers also have to prosper.
Perfect. All right. Well, let's leave it there. Thanks for being on, Andrew.
Thanks for having me.
Great. Well, thanks for joining us, and we'll see you on the next episode. If you learned something from today's show, please leave a review and hit that subscribe button on YouTube, Apple, Spotify, or wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can also get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.